Hey everybody, there's currently something winding its way through Congress that may help you through retirement when it comes to things like your 401k or 403b, so you're not going to want to miss these details. Let's get into it. Hey everybody, my name's AJ and this is The Wealthy Idiots. Today I want to talk about the Secure Act 2.0 that's winding its way through Congress that may have potential to improve retirement savings through your employer for millions and millions of Americans, and it may impact you and me as long as we've been contributing and adding money into our employer-based retirement programs. So we're going to go through it all. The reason I'm commenting on this is because I had a commenter ask me to go over it. We can talk about the different details because it looks like something that might actually pass. It has bipartisan support and seems to be moving its way pretty quickly through our federal government. But I don't personally entirely agree with all of the stuff in here. Not that I disagree with it, but I also don't agree with it. I know that's a little bit cryptic, but if you stick around to the end, I'll explain to you my viewpoint, and I promise that it's not entirely political. It's just a guy who cares about finances who thinks that there may be something better that the government could be doing to set everyone up for their future and financial independence a lot better. And if you stick around, we'll get to it at the end, and I'll tell you what I think should happen. But in the meantime, let's go through the planks of the Secure Act 2.0 and we can see where it's going to be helping out and how it might actually help people out. The first thing that the Secure Act does is it requires automatic enrollment into the employee plan starting at 3% per year, and then it requires an automatic update of 1% every year until it hits 10%. Back in the 90s, the government passed a plan that would allow employers to set up employees' 401k automatically and enroll them automatically, and the employees could then go back and cancel. So you could decide you didn't want to be a part of your employer retirement program and you could cancel it. So they gave the employers the option. This would require employers to enroll people into their retirement program. I think this has the potential of at least starting people out on the right path. Even if they don't entirely agree with that path, they can go back and cancel it later, but at least they get started. They put, some money gets put in, and maybe if they see the potential of that growth, it will show them that this might be a good idea. As it turns out, the employers who set up automatic enrollment through the voluntary program set up in the 90s saw a significant amount of people stay within the program. They were able to build wealth, and now that Congress is looking at that, they're saying, okay, a lot of people found success in this, even if they really weren't thinking about it. Maybe we should have them be automatically enrolled at time of employment, and then they can opt out later if they decide to do so. So it might be an interesting one that will really increase people's 401k contributions. Recently we released an article, and I'll link to it down below, that talked about how much people have in their 401ks, and it's not pretty. Even at retirement, the average American does not have very much in their 401k, and they're looking at retiring with Social Security or having to continue to work because the withdrawals that they can take from that 401k is going to be so low, and that's really depressing. So maybe this plank will fix that problem at least a little bit. The second plank of the Secure Act 2.0, the Savers Credit will increase the number of people that are incorporated, as well as increase the benefit to those people to a flat rate of 50%. Now, what does that mean? So it turns out that if you save money into your employer program and you don't make a lot of money, that there's a cap where you can actually receive a tax credit for simply having put money into your retirement program. The Secure that already exists. The Secure Act will increase the number of people that are incorporated. So I'm assuming that means they're going to increase the number of maybe the minimum amount of income that qualifies somebody. And then previously, the more income you made up until that threshold, the less tax credit you got. But now they're going to add the tax credit to be a flat rate up until that threshold. So you're going to see a really good tax break as a result of saving for retirement, which should hopefully, if you're in a situation where saving for retirement is difficult because you don't have enough money to live on, maybe this will add a little bit more, cover the cost of living expenses so that you could still continue to invest in retirement. That means that you're getting bonus money twice when you invest into an employer retirement program. And what I mean by that is you pay your own money into that program. That money is tax-free at the time you put it in there. The company you work for usually has some sort of match, somewhere between 3 and 6%. They'll match or they'll they'll 50% up to 100% match. They'll put more money in, so instantly you're going to increase the amount of money that you have as soon as it hits that account. And lastly, you get a tax credit if you put that money in there. You're going to receive bonus money 2 times on top of your original money. There is no investment that does that. So this plank is really showing us how big of a deal it is to put money into that retirement program. The third plank is that it's going to increase the amount of money that someone can put in as catch-up contributions. Not catch-up like the jam made out of the fruit known as a tomato. Catch up, as in you didn't invest enough when you were younger and you need to start investing because you're getting closer to retirement. Once you hit a certain age, the government allows you to put more tax benefit free money into these retirement plans, including the Roth IRA, the 401k, and the 403b, and it's going to increase the limit that you have during the last few years of investing. So if you're over 50 years old, or 50 years old and older, I'm not sure if it's inclusive or not, I'll have to take a look at that, but you get to add more money. So for a Roth IRA, if the limit is $5,000, once you hit 50, you could start adding $6,000, and etc. And that changes usually every year, or at least every other year. And they kind of increase like that. They're now adding a plank that once you hit 62, because you can't retire till 65, it allows 3 years of being able to add $10,000. And I'm assuming they're probably going to adjust that as well as time continues to go on. So it gives you a little bit more that you can throw at this retirement account in the last few years so that you can catch up if you weren't investing when you were younger. Like some of us didn't catch on until later in life. But we can make right on it by adding more money in once we're getting closer to retirement. The next plank helps student loan holders. So if you're not putting money into your retirement program because you're trying to pay off your student loans and you're looking at the percentage on those student loans and you're thinking, this is stacking up, the annual interest rate is crazy, and if I make minimum payments, that's going to just increase over time. I got to get this thing paid down. So you take, you're not putting money into your 401k because you're trying to pay that down. Well, you're missing out on the employer match, which is a major bummer. So now employers are going to be required to still match you just towards your student loans instead of that retirement plan. So whatever they put in, it's probably going to be similar to how the 401k works, in that, like, if you put in 6% of your income, your employer will, put in 50%, 75, or 100% match against that income, and then that's the limit that they'll match to, is a certain percentage, like 6%. It'll probably be something similar, like 6% of your income can go to your student loans, and they'll match 50, 75 to 100%, start your student loans, and hopefully help you pay those down faster. And then once you're done with that, you can start investing into your 401k and kind of set yourself up for retirement. So this is an interesting plank that really doesn't affect taxpayers trying to pay off student loans like we talked about before, but it will allow the employer to use that same matching for people who have significant student loans, instead of requiring those people to actually put it in their 401k. So the government is going to start looking at paying off student loans as a part of your retirement plan, which, in all honesty, makes sense. For the next plank, if you didn't know, it turns out that once you hit a certain age, you are required to start taking money out of your 401k. Your 401k is not taxed up front, meaning that every dollar you put into your 401k reduces your overall tax burden when you file for the IRS that year. But when you start withdrawing money from your 401k, it becomes taxable. The thought process is, let's say I make $100,000 now, if I could reduce my tax burden now, I only pay taxes on this much. And then when I retire and I start making withdrawals from the amount of money I invested in this 401k, it's probably going to be lower than my income was whenever I was working. And so then when I pay taxes on that, it'll be in the lower tax brackets. That's the thought process behind why it's tax-free up front, but taxable after the fact. Well, as it turns out, the government wants you to pull money out, because if you don't pull money out, then they can't collect taxes. So there's a minimum withdrawal that hits when you hit the age of 72, and you have to start withdrawing money, or they charge you penalties higher than what you'd probably pay in taxes. And with the Secures Act, they're going to increase that. So there's a set amount of increments where they're increasing it. So next year it'll be 73, by 2029 it'll be 74, and by 2030 something it'll be 79. So they're increasing the age, or no, 75, sorry. They're increasing the age in which you're required to start taking money out so they can collect those taxes, which is kind of cool. This will help people who have the ability to continue working, but maybe not have enough for retirement. continue to allow that to invest and keep going up until that point. There's a certain amount of people that, like, if you haven't invested and you don't have like a really good retirement plan set up, and you're thinking like Social Security and your government or your employer retirement plan is what you got, and you're looking at that thinking, I can't really support myself on this, you're going to have to work a little bit longer. So at least this gives you a few more years to keep working and investing, instead of being forced into withdrawing money and kind of setting yourself up possibly into the future to not being able to retire at all. The next plank has to do with annuities. Now, annuities are interesting. You've heard of life insurance, but you've never heard of live too long insurance. So annuities are a live too long insurance. Basically, the idea is I'm going to pay into this plan that if I end up living longer than what my retirement is capable of keeping me for, like if you planned your retirement to be 100 years old and then some through miracle of medicine or maybe just amazing genes, you live to be 110, 120, you might not have enough money to survive all that if your plan wasn't to live until that point. So an annuity is like an insurance policy you can buy, where if you live past what your retirement expects to go to, so if it's at 100, you hit that 101, they'll start paying you out those insurance claims as a monthly income. And that'll keep you going until you eventually die. That's not a fun topic, but that's how it works. So Secure Act 2.0 allows people to buy annuities through their 401k plan once they hit a certain point, and it will waive some of those minimum deductions that you have to pull money out at a certain age if you choose to go to the annuity route. And that'll make it easier, because then instead of pulling money out of your account and being forced to when you're not ready, you can put that money into an annuity and kind of translate it into an annuity and not pay penalties. So that should help people get live too long insurance, which will help them survive even longer and also be a reduced burden on the government if they get to that point and they just don't have the ability to survive. And lastly, it would reduce costs for employers through two main means. One is it's going to reduce costs and regulations for small businesses, nonprofits, small like government organizations like cities or counties to be able to offer these plans, and to kind of remove the burden of the government cost in filing for these plans, etc., to make it easier for them. And it also offers them a tax credit, an increased tax credit for the amount of matching and everything that they do to really incentivize their matching plans so that more people can get more for retirement. This is mostly aimed at small businesses, which will be hopefully great because they'll be able to provide the same benefits as major businesses and then be able to compete a lot better for employees while growing their business, especially coming out of our whole pandemic event, which was a little bit wild. So that's awesome. So that's the Secure Act 2.0. Now, in the meantime, the House has been working on that, and they've gotten to a point where they've passed it, and now it's kind of being looked at by the Senate. The Senate gets its opportunity to kind of add to it and then kind of send it back to the House. And this is a process that will go back and forth until both parties, both House and Senate, agree on what it should finally be, and then it will end up in front of the president's desk. So the Senate added a couple more interesting things that may or may not make it into the final product, but it's worth taking a look at. The first is emergency savings accounts. Now, this is interesting, and I think this is kind of cool, is that you're capable now of adding with this plan, you would add an emergency savings account like next to your 401k, where you would contribute separately to this emergency savings account, and that emergency savings account would be withdrawable under certain circumstances and certain events, like you lose your job or some major medical expenses occur and you're housing. This would provide like an extra pool, because right now what happens is people get into emergency situations and they have to withdraw from their 401k or their 403b, and that has a lot of penalties, a lot of tax penalties and a lot of burdens as a result of that. So this would allow a separate fund that you could add to while things are good, your job is good, you're paying for everything, and it kind of creates like a mandatory emergency fund, if you will, that you really can't withdraw from except for specific circumstances. So if you're one of the types that have a hard time holding on to cash and it burns a hole in your pocket, and putting money into a emergency fund is just another place for you to like look at savings and kind of drool over what you can do for vacations with that. And no judgment here, I'm speaking from experience, done these things before. This might be a good place to stick your money because you can't really withdraw it except for specific circumstances. So I think this is an interesting one as well. The next plank that they're trying to add is an employee encouragement idea The concept is if you're automatically enrolled and then you decide to pull out of it, this plank would require businesses, companies to encourage you to re-enroll, every certain amount of years. They haven't really pinned that down, but it's looking like maybe about every 3 years they're going to have to send something out, whether it be like an email or a training or something that says like, hey, you opted out of this, but this is a really good idea. You should get into it. Maybe to hopefully encourage more people to, stay in it and not to, leave and to actually start thinking about, retirement plans. So this is an interesting one. And lastly, and this isn't going to affect most people, but they're looking at adding the ability to allow employers of domestic workers, so like nannies or like personal workers in your home, where it's really not like you're not really your own business, so it's hard to provide benefits. They're looking at finding ways to provide similar types of benefits from those kind of single, individual employers to be able to give these same benefits to their employees, and then, hopefully compete with some kind of businesses and corporations, and also help those employees out so that they can have a retirement fund as well. So that might be something that's interesting that might help out, a good subset of the population who might be struggling with retirement plans. Okay, that was a lot. That's all there is now. That doesn't mean that there won't be more later. So this hasn't hit the president's desk yet. He hasn't, vetoed it or approved it. So there could be more amendments attached to this thing, but it does seem to have bipartisan support. Both the Democrats and Republicans seem to love the idea of getting people to invest in retirement. We here at the Wealthy Idiots think it's a great idea that you should be investing for retirement. We encourage it constantly, getting to that point of financial independence. I don't like the idea of relying on the government or other sources, or, small number of sources that could falter at any point and really mess up my plan. So I like the diversified approach of, trying to build financial independence through a lot of different methods and ensuring I have a good solid plan for when I do actually want to retire, whenever that may be. But you stuck it all the way through, and I promised you I would tell you what I think the government should do about retirement plans. And this one might be a little bit wild. If you followed us before, we've talked about the Trinity study, or the 4% rule, and essentially what it says is that you can take whatever your investments are, and you could take 4% of that over a 30-year period. You could take 4% of that every single year and not run out of money, and that would apply to any point in U.S. history, including the Great Depression, and you could still survive on that amount of money. Now, I like to be more on the conservative side. I'm not planning on withdrawing 4% of my income at retirement. I'm probably going to do 3% or lower in order to make sure that I don't run out of money. And I'm also building some sources of cash flow, like my rental properties, dividend payments, different types of interest that are also on top of what my assets might appreciate per year. On the flip side of the 4% rule, you could take what it is that you're trying to get per year and you could multiply that by 25. So 25 is the opposite of 4 when you're talking about, trying to go from, yearly income all the way up to what you need to have invested. The IRA might not like my plan on this one, but I think it's the most sense. I think that you should be able to take whatever the base level income is in the location that you are. So in in California, I think it's like $60,000. In other places, it's like 40, 30, whatever the amount is. For being able to just simply survive, you should be able to multiply that by 25, and whatever number that you come up with should be the amount of money that you should be able to invest tax-free, and you should be able to withdraw tax-free once you hit retirement age and not have to really worry about taxes. Because this is what we're talking about, what it is that you need to survive really shouldn't be taxed by the government. So we already have a concept of this in terms of if you don't make enough money, if there's usually not sales tax on things like food. There's tax deductions for things like being able to buy houses because that's some place you need to live. But we don't have a concept of making sure that people are taking care of themselves and becoming financially independent as if that's not a necessity. And I think that causes problems in terms of if people lose their jobs, they have to look for things like unemployment insurance or government assistance. If they get to a point where they're unable to work through disability, or they get too old and they don't have enough saved, they got to go through government assistance in order to survive. We have plans like Social Security where we're trying to force people essentially to into retirement funds in order to make sure that we could take care of them at a certain point. And some of them are really young when they get to that point. But we don't really have an emphasis on like personal responsibility in terms of making sure that you set yourself up for financial independence in case anything does happen where you could survive. You don't have to withdraw from the system, and then the system can be set aside for people who truly actually need it and just didn't plan improperly. Plenty of people that are struggling that actually need help, and there's plenty of people that are struggling because they didn't plan properly. And I think that the planning properly part should be tax-free up until a certain point. And it should be tax-free for everyone up until that point. So let's say it's like, $2 million invested, and that's the limit. You should be able to invest tax-free up to that $2 million point. And then anything above that, all the rich people obviously will have to pay because they're investing. They won't pay, and we're going to explain why on this channel, why they skip out on taxes, and why you can't, but you could if you watched us. But ultimately, that's my personal opinion. That's how I think that this plan should go. And if you're not putting money into that, and you're using it to buy cars and to buy, vacations and to kind of indulge yourself, then you pay taxes on that. I think that makes sense. And then that goes to cover, whatever social programs are needed in order to ensure that you could survive because you weren't smart enough to get financially independent if all that was tax-free. Now, the government already uses taxation and credits and everything to encourage certain behaviors. We really should have a better tax system to encourage financial independence, and it just isn't there. So that's my 2 cents worth. I appreciate you sticking around to find out. If you have better ideas, please comment below. If you think my idea is garbage, please comment below and let me know. Kind of pick it apart if you'd like. I'd be interested to maybe formulate a better one if I can get some better ideas going. But I appreciate you coming by. Check out thewealthyidiots.com. Link to the article down below. And don't forget to like and subscribe. I'll see you guys next time.